I'm Craig Popp with Accrue Wealth, and this is Charts That Matter. Today, we'll walk through what's been happening in the markets as a surge in headline volatility has shaped what we're seeing. AI concerns have hit industries one by one, prompting a sell now, ask later reaction. We'll expand on this discussion later. Geopolitical tensions from Iran to Venezuela to Greenland have added to the noise. And tariff uncertainty is back following the Supreme Court's ruling to nullify the IEEPA tariffs, with new Section 122 tariffs creating short-term confusion for the markets. The S&P is slightly negative year to date. However, there's been a lot of movement underneath. About 20% of S&P stocks are down more than 10%, and 10% are down more than 20%, even while the average stock is actually up 7%. Considering all this, the recent consolidation is normal and even healthy after an 86% market run in the last 3 years. Tech mega caps have cooled, but that's allowed other areas to lead. Cyclicals are improving, credit spreads remain narrow by historical standards, and many stocks are hitting new highs, giving the broader market solid support. A bit of fear is returning, which can be constructive as markets often climb a wall of worry. The economic backdrop remains strong. Tax stimulus, monetary easing, deregulation, and productivity gains are giving the economy tailwinds. Corporate investment is booming, especially in AI infrastructure. Hyperscaler CapEx could reach over $600 billion by the end of the year, providing real fuel for growth. Earnings are also solid. 75% of S&P 500 companies beat expectations. Margins are holding and growth is broadening, helped by rising AI adoption. Let's shift into discussing the current state of AI, its overall impact on the economy, and why it requires some patience from investors. Change takes time. Artificial intelligence is clearly transformative, but it's also still in the early stages of adoption. With job growth slowing, it's understandable that people worry about whether AI might hurt employment or slow economic momentum. Forecasts today are all over the map. Some predict major productivity gains, others warn of significant job displacement. History gives us some helpful perspective here. When electricity was introduced, automobiles emerged, when computers became mainstream, and later when the internet reshaped entire industries, none of those shifts happened overnight. Real transformation took time and required businesses to redesign processes, retrain workers, and build completely new products and services. And yes, there were periods of disruption along the way, but in every case, the long-term result was overwhelmingly positive. Stronger productivity, faster economic growth, and ultimately healthier labor markets. AI is likely to follow a similar path, meaning gradual adjustment, not sudden displacement. Even with this perspective, the market reaction the past few weeks has been intense. We've seen aggressive selling in areas seen as most exposed to AI-related competition. Notably, these moves weren't caused by deteriorating fundamentals. In fact, the economy remains resilient and recent earnings have been solid. Instead, sentiment shifted after several new AI tools were released by emerging startups. Tools that sparked fears about what AI could automate or replace. Let's take a closer look at 3 of the sectors most affected. First is software, where the pullback has been driven more by fear than fundamentals. Software stocks have been hit especially hard, falling more than 25% from recent highs. Why? New AI tools, including some aimed at legal workflows, raise concerns that traditional software products could lose relevance. Add in high valuations and the sell-off accelerated quickly. But the more likely scenario is not that AI replaces software, it's that AI becomes deeply integrated into it. We're already seeing this trend. At Anthropic's recent Enterprise Agent event, for example, they announced partnerships across tax preparation, clinical trials, and customer engagement. This illustrates that AI is being embedded into existing platforms, not pushing them aside. With valuations now at their lowest level in several years, and earnings expectations holding steady, this pullback may actually represent an attractive entry point, particularly for well-established companies with strong customer integration and competitive moats. Another area under pressure has been cybersecurity. Anthropic introduced a tool called Claude Code Security, designed to scan code and identify vulnerabilities. The announcement alone triggered a sell-off of about 10% across many cybersecurity names. But cybersecurity isn't optional, it's foundational. As companies increasingly rely on AI, and as AI-driven threats grow more sophisticated, demand for cybersecurity solutions should only rise. Global cybercrime costs are projected to exceed $15 trillion by 2030, up from about $10 trillion last year. That's a massive and growing challenge that no single AI tool can solve on its own. In reality, AI advancements make cybersecurity more, not less important. So while volatility may continue in the short run, the long-term outlook remains strong. And last is wealth management, a familiar fear but an unlikely threat. The wealth management sector experienced its own AI-driven sell-off after a startup company announced a tool that creates custom investment and tax strategies for individuals. This sparked flashback fears of robo-advisors more than a decade ago. At that time, many predicted that automated tools would replace human advisors, but that never happened. Instead, robo-advisors became one component of a broader ecosystem. Useful, but not a substitute for the trust, guidance, and personalized judgment that advisors provide, especially during periods of uncertainty. AI tools today may be more sophisticated, but the conclusion is similar. They are likely to enhance an advisor's capabilities, not replace them. The recent sell-off in this space appears disproportionate to the actual risk. So what should we take away from this period of heightened volatility? AI fears have clearly fueled significant, sometimes indiscriminate selling as investors try to separate potential winners from potential losers. But historically, markets often overreact when new technologies emerge, and this time may be no different. The fundamentals of the economy remain solid and can be a tailwind for stock prices. Earnings are strong and broadening out. The broadening market fundamentals have brought more companies into investors' favor as valuations were reasonable for the average stock. A final reminder that diversified portfolios are benefiting from this year's rotation. Be patient, take advantage as opportunities arise, and remember the first rule of compounding: never interrupt it unnecessarily.